Before we begin, a brief word. If you're looking for thoughtful, disciplined financial insights without the noise, without the hype, and without the emotional manipulation that dominates so much of financial media today, consider subscribing to this channel. Also add subscribe button in red color. We focus on what matters: strategy, risk management, clear thinking during uncertain times. Now, let's discuss what just happened in the silver market and what it means for your financial decisions moving forward. Silver just experienced a shock collapse, a 10.5% drop in a matter of days. For an asset class that's supposed to serve as a safe haven, as a hedge against uncertainty, this kind of violent move raises serious questions. Questions that every holder of precious metals needs to answer. Questions that every investor watching from the sidelines needs to understand. But here's what makes this moment particularly significant. While the price was falling, something else was happening, something quieter, something most retail investors won't notice until it's too late. Big money was moving, institutional players were repositioning, smart capital was making decisions, decisively and without emotion, and those decisions are telling us something about the months ahead, something about the real forces driving asset prices right now, something about where the genuine opportunities and dangers actually lie. This isn't about predicting the next price level, it's about understanding the game that's being played, about reading the signals that matter, about making rational decisions when everyone else is either panicking or denying reality. So let's be clear about what we're doing here. We're going to examine exactly what happened. We're going to understand why it happened. We're going to look at what history teaches us about moments like this, and we're going to develop a framework for action, whether you're currently holding silver or whether you're considering an entry point. Most importantly, we're going to discuss the mistakes that destroy wealth during volatile periods like this, the behavioral errors, the emotional reactions, the cognitive traps that separate disciplined investors from everyone else. Let's begin. First, the facts. Silver prices dropped 10.5% over a compressed time frame. This wasn't a gradual decline. This was rapid, decisive. The kind of move that triggers stop losses, forces margin calls, and creates cascading selling pressure. The spot price fell from levels that had been holding relatively stable through key technical support zones and into territory that hasn't been tested in months. Volume was significant. This wasn't a thin market with low liquidity creating exaggerated moves. This was real selling, real capital exiting positions. Now, here's what makes this interesting. Gold, silver's more famous cousin, didn't experience the same magnitude of decline. Yes, gold pulled back, but nothing approaching 10.5%, nothing approaching the violence we saw in silver. This divergence matters. It tells us something specific about silver's unique characteristics, about its position between precious metal and industrial commodity, about the different forces that drive its price. Futures positioning shifted dramatically. Open interest in silver futures contracts changed. The commitment of traders report, which shows us how different categories of market participants are positioned, revealed something important. Commercial hedgers, the entities closest to physical silver production and consumption, were reducing short positions. Managed money, the speculative long positions, were being unwound. Translation: the speculative enthusiasm that had built up in silver was being systematically dismantled. Meanwhile, something else was happening in related markets. The US dollar strengthened, treasury yields moved, risk appetite across broader equity markets showed signs of cooling. These aren't isolated events, they're connected. And they're all pointing toward a shift in the underlying conditions that drive precious metals pricing. Let's establish context. What is silver, really? Silver occupies a unique position in the financial universe. It's not purely a monetary metal like gold. It's not purely an industrial commodity like copper. It's both. And that duality creates distinctive price behavior. Roughly half of silver demand comes from industrial applications: electronics, solar panels, medical devices, automotive components. This industrial demand is tied to economic growth, technological trends, and manufacturing cycles. The other half comes from investment demand and jewelry. This portion responds to inflation expectations, currency concerns, and safe haven seeking behavior. This dual nature creates complexity. It means silver can rise when economic growth accelerates because industrial demand increases, but it can also rise when economic uncertainty increases because safe haven demand increases, and it can fall when both forces align against it. Silver is more volatile than gold, significantly more volatile. The silver to gold ratio, how many ounces of silver it takes to buy 1 ounce of gold, swings wildly across different market regimes. Historically, this ratio has ranged from 15:1 to over 101. Wide swings, massive divergences. This volatility isn't a bug, it's a feature of silver's dual nature. For speculators, this volatility represents opportunity. For long-term holders, it represents risk that must be managed. For those trying to use silver as portfolio insurance, it represents a tool that doesn't always behave as expected. Understanding this nature is critical because it shapes how we should think about silver during a 10.5% collapse. Is this a failure of silver as a monetary hedge? Or is this industrial demand concerns overwhelming monetary demand? Or is this simply normal volatility within a broader uptrend? Or is it something else entirely? The answer determines everything about how we respond. So why did this happen? What actually drove this 10.5% collapse? Let's work through the layers. First, the dollar. The US dollar index strengthened during this period. When the dollar rises, dollar-denominated commodities typically fall. This is mechanical, it's arithmetic. A stronger dollar means it takes fewer dollars to buy the same amount of silver. But there's more to it than simple currency effects. Dollar strength reflects expectations. Expectations about interest rates, expectations about capital flows, expectations about relative economic performance between the United States and the rest of the world. When the dollar strengthens because investors believe U.S. rates will remain elevated, or because capital is flowing toward dollar-denominated assets, this creates headwinds for non-yielding assets like precious metals. Second, real interest rates. This is critical. Silver, like gold, generates no yield. It sits there. It doesn't pay dividends. It doesn't generate cash flow. Its value is entirely based on future price appreciation and its perceived properties as a store of value. When real interest rates, nominal rates minus inflation expectations, rise, the opportunity cost of holding silver increases. Why hold silver generating 0% when you can hold treasury bonds generating positive real returns? This dynamic shifts capital. It changes the calculus for institutional investors. It reduces speculative positioning. Third, economic growth expectations shifted. Recent economic data has been mixed. Some indicators pointing toward resilience, others pointing toward deceleration. This uncertainty creates volatility in industrial commodities. If investors begin pricing in weaker economic growth, industrial demand for silver comes into question, and that's half of silver's demand equation. Fourth, and this is important, risk sentiment. Silver has increasingly traded like a risk asset. When risk appetite is strong, silver rises. When risk appetite wanes, silver falls. Look at the correlation between silver and equity market volatility over the past several years. It's there. Recent turbulence in equity markets, concerns about valuations, and general risk-off positioning likely contributed to silver's decline. Fifth, technical factors. Silver broke through key support levels. This triggered algorithmic selling. It triggered stop-loss orders. It created momentum in the downward direction that fed on itself. Technical breakdowns often create outsized moves because they force mechanical selling regardless of fundamental views. Sixth, and here's where it gets interesting, positioning. Prior to this collapse, speculative positioning in silver was elevated. Managed money was net long. Retail investors had piled in. Social media sentiment was bullish. This crowded positioning made silver vulnerable. When everyone who wants to buy has already bought, there's no one left to push prices higher. And when sentiment shifts, the exit becomes crowded. Large institutional players, the smart money, likely recognized this setup, and they acted accordingly. Let's look backward. Because markets rhyme, silver has experienced dramatic drawdowns before, many times. Understanding these historical episodes provides perspective. In 1980, silver hit $50 per ounce during the Hunt Brothers episode. Then it collapsed. It took decades to revisit those levels. Decades. In 2011, silver spiked to nearly $50 again, driven by post-financial crisis monetary policy, inflation fears, and speculative mania. Then it crashed. It fell by more than 60% over the following years. In 2020, during the pandemic-driven market turmoil, silver initially crashed with everything else. Then it rocketed higher as stimulus flooded the system. Then it consolidated and pulled back again. The pattern? Volatility. Sharp moves in both directions. Extended periods of going nowhere. Brief moments of explosive action. But here's what matters more than the price moves themselves. Each of these historical episodes taught lessons about market psychology, about the difference between fundamental value and speculative excess, and about the importance of understanding what's driving price action. The investors who survived and prospered through these cycles weren't the ones who tried to time every twist and turn. They were the ones who understood their time frame, who sized positions appropriately, who didn't overlever, and who had a clear framework for when to hold and when to exit. Let's also consider the broader context of commodity cycles. Commodities move in long cycles, decades-long cycles, periods of extended bull markets followed by extended bear markets. Silver participates in these cycles, but with amplified volatility. The 1970s saw a major commodity bull market. The 1980s through early 2000s saw a major bear market. The 2000s through 2011 saw another bull market. The 2010s saw consolidation and decline. Where are we now? That's the question. Some argue we entered a new commodity supercycle driven by underinvestment in supply, green energy transition, and fiscal stimulus. Others argue we're in a temporary spike that will reverse as rates normalize and growth slows. The 10.5% collapse in silver doesn't answer this question definitively, but it does tell us that the path forward won't be straight, that volatility remains the norm, that conviction in either direction should be held lightly. Now let's talk about the quiet moves, the institutional repositioning that most retail investors miss. Large players don't trade based on emotion, they trade based on models, positioning analysis, macroeconomic forecasts, and flow dynamics. They have access to data and resources that retail investors don't. When silver collapsed 10.5%, what were they doing? Some were reducing exposure, taking profits from positions established at lower levels, de-risking portfolios ahead of uncertain macro conditions. This is standard risk management. Some were shifting allocation, moving capital from silver into other areas, offering better risk-adjusted returns, perhaps into gold, which showed relative strength, perhaps into shorter duration fixed income as yields rose, perhaps into cash as a strategic reserve. Some, and this is crucial, were likely accumulating, using the volatility to establish positions at better entry points, building strategic allocation in a dispassionate, systematic way. The key insight? Big money doesn't panic. Big money doesn't chase. Big money uses volatility as opportunity, not as reason for fear. Consider the futures market structure. Backwardation versus contango, the shape of the forward curve, the cost of carry. These technical factors tell sophisticated traders when conditions are favorable or unfavorable. Large institutional investors also understand something that retail investors often miss: mean reversion within volatility. A 10.5% move in silver is dramatic, but it's not unprecedented, and if the long-term fundamental case remains intact, these moves represent noise rather than signal. Signal versus noise, one of the most important distinctions in all of investing. Big money asks different questions than retail investors. Retail asks, should I panic? Is this the top? Did I make a mistake? Institutional asks, has the fundamental thesis changed? How does this move affect our portfolio construction? Where is risk-reward most attractive now? The difference in framing creates the difference in outcomes. If you currently hold silver, you're facing a decision point. Let's think through this clearly. First, revisit your thesis. Why did you buy silver in the first place? Was it as an inflation hedge? As insurance against currency debasement? As a speculation on industrial demand? As portfolio diversification? As a trading vehicle? Your original thesis matters because it determines whether a 10.5% decline invalidates your position or represents temporary volatility within an intact strategy. If you bought silver as long-term insurance against monetary instability, has the case for monetary instability decreased? Or has it actually increased while silver's price temporarily declined? These are different situations requiring different responses. Second, assess your time horizon. If you're a short-term trader, a 10.5% move demands action. Respect your stops, manage your risk. Don't let a trading position become a forced investment. If you're a long-term holder, short-term volatility is expected. It's the price of admission for potential long-term returns. Reacting emotionally to normal market fluctuations destroys wealth over time. Third, evaluate your position sizing. If this 10.5% decline is causing you stress, anxiety, or sleepless nights, your position is too large. Period. Proper position sizing means volatility is uncomfortable but manageable. It doesn't threaten your overall financial stability. It doesn't force decisions during moments of maximum uncertainty. If you're overexposed, use this as a lesson. Consider reducing exposure to a level that allows clear thinking. Fourth, consider the opportunity cost. Capital allocated to silver is capital not allocated elsewhere. Are there better opportunities now? Has the risk-reward profile shifted enough to warrant reallocation? This isn't about abandoning silver because it declined. It's about continuously evaluating where your capital is best positioned given current conditions. Fifth, look for tax efficiency opportunities if relevant. In taxable accounts, losses can offset gains. Strategic tax loss harvesting can add value without changing your fundamental exposure if executed properly. Sixth, and this is critical, do not average down emotionally. It's cheaper now, so I should buy more is not a strategy. It's a rationalization. Averaging down works only if your analysis says the asset is genuinely undervalued and your original thesis remains valid. Averaging down simply because price declined is how small losses become catastrophic ones. Seventh, remove emotion from the equation. Fear and greed are your enemies. The 10.5% decline feels significant because humans are loss averse. We feel losses roughly twice as intensely as equivalent gains. This psychological asymmetry clouds judgment. Recognize it. Account for it. Make decisions based on logic and analysis, not on how the loss feels. Finally, consider hedging strategies if you're committed to long-term holding but want to reduce short-term volatility. Options, strategies, tactical stops, or pairing silver with negatively correlated assets can reduce portfolio volatility without completely exiting the position. But be aware, hedging has costs. It reduces potential upside. It adds complexity. It's not appropriate for everyone. If you don't currently hold silver but have been watching, this collapse presents a different set of considerations. First, understand that trying to catch the absolute bottom is a fool's errand. The lowest price will only be known in retrospect. Attempting to time it perfectly leads to paralysis or late entry after the move has already occurred. Instead, think in terms of ranges. Is silver entering a range where risk-reward becomes attractive based on historical context and fundamental analysis? Second, consider whether the decline has changed the fundamental picture. If silver fell because of factors that are likely temporary, technical selling, positioning liquidation, short-term risk-off sentiment, that's different than if it fell because the underlying fundamental case deteriorated. A price decline driven by temporary factors creates opportunity. A price decline driven by fundamental deterioration creates a value trap. Third, define your time frame before entering any position. Are you buying for a tactical trade based on mean reversion? For a strategic allocation as portfolio insurance? For a multi-year thematic investment in precious metals? Your time frame determines your entry strategy, your position size, and your risk management approach. Fourth, scale into positions rather than committing capital all at once. When volatility is elevated and direction is uncertain, incremental entry reduces timing risk. Buy in tranches. Establish positions over time. This averages your cost basis and reduces the psychological pressure of perfect timing. Fifth, understand the vehicles available. Physical silver has different characteristics than silver ETFs. Silver mining stocks have different characteristics than silver itself. Futures and options have leverage and decay considerations. Each vehicle serves different purposes and carries different risks. Match the vehicle to your strategy. Sixth, consider portfolio context. How does silver fit within your overall asset allocation? What role does it play? How does it correlate with your other holdings? Silver as 2% of a diversified portfolio is different than silver as 20%. Scale matters, purpose matters, integration with the rest of your financial plan matters. Seventh, prepare for continued volatility. Entering a silver position now means accepting that further drawdowns are possible, maybe even likely. Can you handle another 10% decline? Another 20%? If not, either size your positions smaller or wait for clearer conditions. Eighth, develop your exit framework before entering. What conditions would cause you to sell? What price levels? What fundamental changes? What time horizon? Knowing your exit before entering eliminates emotional decision-making during maximum stress. Ninth, consider the macroeconomic environment. Is the backdrop becoming more favorable for silver or less favorable? Are real rates trending up or down? Is inflation surprising to the upside or downside? Is industrial demand strengthening or weakening? Don't invest against the macro tide, unless you have very strong conviction and a long time frame. Finally, remember that no asset is always a good buy, regardless of price. Silver at $15 per ounce has different risk reward than silver at $35 per ounce. Valuation matters, context matters, price matters. The fact that silver declined 10.5% doesn't automatically make it attractive. It might be the first leg of a larger decline, or it might be a gift. Analysis determines which. Let's be direct. Here are the behavioral errors that destroy wealth during volatile periods. Mistake 1, panic selling near the bottom. When an asset you own collapses 10.5%, the emotional instinct is to sell, to stop the pain, to avoid further losses. This instinct is exactly backward. If your original thesis was sound and the fundamentals haven't changed, selling after a sharp decline locks in losses and removes you from the position right when risk-reward may be improving. This doesn't mean never sell. It means don't sell purely from emotion. Don't sell simply because price went down. Mistake 2, revenge trading. Some investors respond to a loss by immediately trying to make it back through aggressive trading, increasing position size, taking on more risk, chasing quick returns. This is emotional compensation, not strategy. It typically leads to larger losses. The market doesn't care about your need to recover. It doesn't owe you anything. Mistake 3, averaging down without reassessment. It's cheaper, so I should buy more, is not analysis. Before adding to a losing position, thoroughly reassess whether your thesis remains valid. Sometimes averaging down is brilliant. Sometimes it's pouring good money after bad. The difference is whether the fundamental case strengthened, stayed the same, or weakened. Mistake 4, ignoring position sizing. Taking a position that's too large relative to your capital and risk tolerance forces bad decisions. You can't think clearly when your financial stability is threatened. Proper position sizing means volatility is uncomfortable but manageable. It allows you to hold through drawdowns without panic. Mistake 5, over-leveraging. Using margin, futures, or leveraged ETFs amplifies returns but also amplifies losses. A 10.5% decline in silver becomes a 20% or 30% or 50% decline in a leveraged position. Leverage turns normal volatility into catastrophic losses. It forces sales at the worst possible time through margin calls. It's the primary way retail investors are wiped out. Mistake 6, following the crowd. When silver was rising, everyone was bullish. Now that it's falling, everyone is bearish. The crowd is consistently wrong at extremes. Contrarian thinking doesn't mean automatically doing the opposite of the crowd. It means thinking independently and recognizing when sentiment has reached unsustainable levels. Mistake 7. Believing you can time every move. Trying to sell before every decline and buy before every advance is impossible. Transaction costs, tax implications, and emotional exhaustion make this approach counterproductive. Instead, focus on getting the big decisions right. Trend direction, major entry, and exit points. Asset allocation. These matter more than perfect timing. Mistake 8. Ignoring the broader portfolio. Silver is one holding within a larger financial plan. Obsessing over one position while ignoring the overall portfolio is misplaced focus. Maybe silver declined 10.5%, but your bonds increased. Maybe your overall portfolio is still positive. Context matters. Mistake 9. Listening to promoters with agendas. The precious metals space is filled with permabulls who always find reasons why silver should be higher. They profit from selling, from commissions, from affiliate relationships. Objective analysis considers both bullish and bearish cases. It acknowledges uncertainty. It doesn't promise outcomes. Mistake 10. Forgetting that volatility is the price of admission. If you want the potential upside of silver, you must accept the volatility. There's no free lunch. Assets that move smoothly upward without drawdowns don't exist. The 10.5% decline isn't a failure of silver. It's silver being silver. If you can't handle this volatility, you shouldn't own silver. Mistake 11. Making major decisions during high emotion. And when fear peaks or greed peaks, that's precisely when you should not be making large capital allocation decisions. Step back. Wait for clarity. Let emotion subside. Then decide. Mistake 12. Failing to learn from the experience. Every market event is a lesson. What did this 10.5% collapse teach you about your risk tolerance, about your position sizing, about your emotional discipline? Investors who extract lessons from volatility improve over time. Those who don't repeat the same mistakes endlessly. This silver collapse doesn't exist in isolation. Let's zoom out. What does a 10.5% decline in silver tell us about broader market conditions? First, it suggests risk appetite is fragile. When risk assets, and silver increasingly trades as a risk asset, experience sudden sharp declines, it often precedes or accompanies broader market volatility. Watch equity markets, watch credit spreads, watch volatility indices. If silver's decline is part of a larger risk-off move, other assets will follow. Second, it signals the importance of dollar and rate dynamics. If the dollar continues strengthening and real rates continue rising, then this creates headwinds for multiple asset classes, not just silver, other commodities, emerging markets, long-duration bonds. Understanding the macro regime, the dollar, rates, growth, inflation, is essential for navigating all markets, not just precious metals. Third, it highlights the danger of crowded positioning. When too many investors pile into the same trade, the exit becomes painful. This is true for silver today. It might be true for other popular trades tomorrow. Where else is positioning crowded? Where else is sentiment excessively bullish? Those are the areas of vulnerability. Fourth, it reinforces the value of diversification. A diversified portfolio doesn't prevent losses in individual positions, but it prevents single positions from destroying overall wealth. If silver was 5% of your portfolio, a 10.5% decline in silver is a 0.5% decline in your overall portfolio. Manageable, survivable, not catastrophic. If silver was 50% of your portfolio, a 10.5% decline in silver is a 5% decline in your overall portfolio. Much more significant, much more stressful. Fifth, it reminds us that safe havens aren't always safe. During calm periods, everyone assumes precious metals will protect them during chaos. But sometimes, precious metals decline during chaos. Sometimes correlation breaks down. True portfolio insurance requires thinking more deeply than gold and silver always protect me. Sixth, it demonstrates the power of systematic rebalancing. If you have target allocations and rebalance systematically, silver declining means you automatically buy more. You add to positions when they're down. You trim when they're up. This removes emotion and enforces contrarian behavior, buying low and selling high, automatically. So where do we go from here? Honest answer? Nobody knows. Silver could rebound sharply from here. It could consolidate and go sideways. It could continue declining. The future is uncertain. Always has been, always will be. But uncertainty doesn't mean helplessness. It doesn't mean we can't prepare. It doesn't mean we can't position ourselves intelligently. Here's what we know. Silver's dual nature, monetary and industrial, means it will remain volatile, more volatile than gold, more volatile than bonds, more volatile than most stable equity indices. This volatility creates opportunity for those who can stomach it and execute with discipline. The macro environment will continue driving precious metals prices. Dollar strength, real interest rates, inflation expectations, and risk sentiment matter more than anything else. Watch these indicators. Understand these forces. Adjust your positioning as conditions change. Industrial demand for silver will depend on economic growth and technological trends. The green energy transition could support long-term demand, but short-term demand fluctuates with business cycles. Investment demand will depend on trust in fiat currencies, fear of financial system instability, and opportunity cost relative to other assets. Both demand sources matter. Both should inform your analysis. The smartest approach for most investors isn't trying to time every move. It's establishing a position size they can hold through volatility, understanding their time horizon, and sticking to their strategy unless fundamentals change. For some, that means holding strategic silver allocation as insurance, regardless of short-term price moves. For others, that means being tactical, adding exposure when risk-reward is attractive, reducing when it's not. For others still, it means avoiding silver entirely because the volatility doesn't match their temperament or timeline. All three approaches can be correct. What matters is knowing which one is yours and executing it with discipline. Let's talk about psychology, because this is where most investors fail. The human brain is not designed for successful investing. Evolution optimized us for survival in immediate physical environments, not for long-term capital allocation under uncertainty. We are loss-averse. We feel losses roughly twice as intensely as equivalent gains. A 10.5% decline in silver feels worse than a 10.5% gain feels good. This asymmetry causes us to sell winners too early and hold losers too long. We lock in gains to stop the anxiety of giving them back. We hold losses, hoping they'll recover to avoid admitting we were wrong. Both behaviors destroy wealth over time. We're prone to recency bias. Recent events feel more important than historical patterns. Silver dropping 10.5% feels like a catastrophe because it just happened, even though similar declines have occurred repeatedly throughout history. This makes us overreact to volatility. It makes us forget the long-term context. We seek confirmation of what we already believe. If you're bullish on silver, you'll find bullish analysis convincing and dismiss bearish analysis. If you're bearish, the reverse. This confirmation bias prevents us from seeing the full picture. It traps us in echo chambers. We're influenced by social proof. When everyone around us is buying, we want to buy. When everyone is selling, we want to sell. The crowd becomes its own justification. But the crowd is consistently wrong at extremes. When everyone is bullish, there's no one left to buy. When everyone is bearish, there's no one left to sell. We experience sunk cost fallacy. We hold positions because we've already invested time, energy, and capital, even when the rational decision is to exit. I've held this long, I might as well keep holding, is not analysis. It's rationalization. Successful investing requires overcoming these psychological pitfalls. It requires rules-based decision-making. Clear frameworks established during calm periods that guide behavior during chaos. It requires accepting uncertainty, acknowledging that we don't know what will happen next and positioning for multiple possible outcomes. It requires humility, recognizing that we're wrong frequently and adapting when evidence changes. It requires patience, understanding that wealth compounds over years and decades, not days and weeks. Most importantly, it requires emotional detachment from individual positions. Silver is not your identity. Your self-worth is not tied to whether silver goes up or down. It's capital allocated to an asset as part of a broader strategy. When you can view positions dispassionately as capital deployed with specific risk-reward characteristics, you can make better decisions. When positions become emotional, when they represent your ego or identity, you've already lost. The 10.5% collapse in silver is a stress test, not just for silver. For you, how did you react? Did you panic? Did you become paralyzed? Did you make impulsive decisions? Or did you step back, assess objectively, and think clearly? Your reaction tells you something important about your risk tolerance, your position sizing, and your emotional discipline. Use this information. If the decline caused severe stress, you need to adjust. Either reduce position size, increase diversification, or avoid volatile assets entirely. There's no shame in acknowledging your limits. In fact, it's a sign of wisdom. Building resilience means preparing for volatility before it happens. It means having a written investment plan that outlines your strategy, your rules for entry and exit, and your maximum position sizes. It means stress testing your portfolio. What happens if silver drops another 20%? What happens if your largest holding declines 50%? Can you survive? Can you maintain your lifestyle? If not, you're overexposed. It means maintaining adequate liquidity. Cash isn't trash during a crisis, it's optionality. It's the ability to act when others are forced to react. The investors who prosper during volatility are the ones with dry powder, the ones who can buy when everyone else is forced to sell. It means diversifying not just across assets, but across strategies. Some positions are long-term holdings, some are tactical trades, some are hedges. This diversity reduces the chance that everything goes wrong simultaneously. It means controlling what you can control. You can't control silver's price, you can't control market volatility, you can't control macro conditions, but you can control your position sizing, your entry and exit rules, your emotional reactions, your continuous learning. Focus on what's within your control, accept what isn't. It means developing independent thinking, not following the crowd, not outsourcing your decision-making to promoters or talking heads. Do your own analysis, form your own views, be willing to be wrong, be willing to change your mind. Finally, it means remembering your long-term goals. Why are you investing in the first place? Financial security, independence, generational wealth, retirement, comfort? Keep those goals front and center. Don't let short-term volatility and individual positions distract you from the larger purpose. A 10.5% decline in silver is irrelevant if your overall financial plan remains on track. Let's bring this together. Silver dropped 10.5%. It was sharp, it was painful for holders. It raised questions for everyone watching. But this is not a unique event. It's not unprecedented. It's not even particularly unusual for silver. What matters is not the decline itself. What matters is how you respond. Do you react emotionally or think strategically? Do you panic or analyze objectively? Do you abandon a sound plan or execute with discipline? The investors who build lasting wealth share common characteristics. They think long-term while managing short-term risk. They maintain discipline when emotion peaks. They learn from every market cycle. They stay humble and adaptable. They don't try to predict every twist and turn. They don't claim certainty where none exists. They don't allow individual positions to dominate their thinking or threaten their overall financial health. They understand that volatility is the price of admission for superior returns. They accept it. They prepare for it. They don't complain about it. Most importantly, they keep perspective. A 10.5% move in silver is one data point in a lifetime of investing, one moment in decades of financial decision-making, one wave in an endless ocean. It neither proves nor disproves anything fundamental about your strategy. What proves your strategy is consistency over time. It's the cumulative result of hundreds of decisions made with discipline and intelligence. It's surviving the drawdowns. It's capturing the uptrends. It's avoiding catastrophic mistakes. It's compounding steadily without interruption. You can't control whether silver rises or falls from here. Nobody can. But you can control whether you've positioned appropriately, whether your risk management is sound, whether your time frame matches your holdings, whether your emotional discipline is intact. Focus on what you can control. Execute with clarity. Learn continuously. Stay disciplined. The investors who do these things consistently don't need to predict the future. They're prepared for multiple futures. They'll prosper regardless of which one arrives. This collapse in silver is not the end of anything. It's not the beginning of anything. It's a moment. One moment among thousands you'll experience as an investor. Treat it as such. Use it as a stress test, as a learning opportunity, as a reminder of what matters in investing, and then move forward, thoughtfully, strategically, with discipline. That's how wealth is built. That's how financial goals are achieved. That's how you succeed over the long term, not by predicting every market move, not by avoiding all volatility, not by always being right, but by staying in the game, by managing risk intelligently, by learning from experience, by maintaining discipline when others lose theirs. The path forward isn't about silver specifically. It's about your entire approach to investing, your mindset, your framework, your consistency. Get those things right, and individual market moves become manageable. They become part of the process rather than threats to your success. That's the real lesson from this 10.5% collapse. Not what it means for silver's next move, but what it reveals about your readiness for the inevitable volatility that defines all investing. Build that readiness, strengthen that discipline, maintain that long-term focus, and you'll be prepared not just for what happens with silver, but for whatever markets bring over the years ahead. Thank you for your time and attention. Stay disciplined, stay focused, and keep building the financial future you deserve.